The technology sector took a heavy beating today, dragging the Nasdaq down almost 2% or over 500 points. This marks the fourth consecutive day of declines for the tech-heavy index. While the market opened with brief gains, persistent selling pressure quickly took over, pushing major indices close to their recent lows and showing that momentum is stalling. Behind today's decline is a fundamental shift in how the artificial intelligence build-out is being funded. Hyperscalers and hardware makers are moving from self-funded capital spending to dilutive equity and debt raises. This is starting to extract cash directly from the public markets, reducing the secondary market float that has supported tech valuations for months. The clearest example of this funding squeeze is Supermicro. Shares of SMCI plummeted 28% in today's session after the company announced a massive $7 billion equity offering. This capital is intended to fund a $39 billion backlog in server orders, but it dilutes existing shareholders by 27%, prompting a swift repricing. Oracle added to the capital concerns after reporting its fourth quarter results. Although earnings beat expectations, cloud revenue fell slightly short at $9.9 billion. More importantly, Oracle announced plans to raise $40 billion in fiscal year 27 through debt and equity, reminding investors how capital-intensive this infrastructure build remains. Macro headwinds also intensified today with the release of the May Consumer Price Index. Headline inflation rose to 4.2% year-over-year, marking the first time it has exceeded 4% in 3 years. While core inflation was relatively mild, at 2.9%, the hot headline print limits the Federal Reserve's room for monetary easing. Adding to rates anxiety is next week's Federal Reserve meeting, where incoming Fed Chair Kevin Warsh will hold his first press conference. Markets are treating this transition with caution, viewing Warsh as a hawkish uncertainty. Bond yields fluctuated wildly today as traders adjusted their rate cut expectations ahead of this leadership change. Highlighting the scaling capital needs in AI, OpenAI has confidentially submitted its draft S-1 registration statement to the SEC. Although Chief Financial Officer Sarah Frier is reportedly counseling patience due to differences with Sam Altman over IPO readiness, the move signals the next major wave of public AI financing. This comes as Friday's scheduled SpaceX IPO seeks to raise $75 billion, showcasing the historic demand for private tech assets transitioning to the public markets. Competitive supply in the hardware space is expanding. SK Hynix has filed for a U.S. ADR listing, aiming to raise up to $14 billion as early as August. While this shows robust global demand for high-bandwidth memory, the new U.S. share supply could pressure the valuations of domestic storage peers like Micron and SanDisk. Emerging currency markets are showing signs of stress from this global dollar shortage. Bank Indonesia unexpectedly raised its benchmark policy rate to 5.5% in an unscheduled meeting. Meanwhile, South Korea launched joint foreign exchange bank inspections for the first time in 14 years to prevent capital flight. These structural pressures are exposing the valuation risks in broad U.S. indexes. The S&P 500 is trading at record highs, but its dividend yield has fallen to just 1%. This record low yield leaves passive index investors with virtually no margin of safety if earnings growth begins to slow. To put that in perspective, a simple reversion of the S&P 500 dividend yield from 1% back to its historical average of 2% would represent a 50% decline in stock prices. While this is a worst-case scenario, it highlights how much equity valuations rely on permanently low discount rates. For investors seeking shelter from index concentration, fundamental value alternatives are gaining attention. Berkshire Hathaway, for example, generates approximately $45 billion in annual earnings, offering a more stable, cash-backed profile and a lower relative valuation than the overextended tech giants. As we monitor this market transition, our focus is on 3 key triggers. First, whether SMCI shares find support after today's dilution drop. Second, the bond market's reaction to the hot CPI print. And third, the regulatory progress of the SK Hynix ADR listing ahead of August.